Welcome to the Opening Bell Report.
Welcome in, grab a seat, get comfortable, and let's bring you right into the current moment.
Right into the chaos.
Yeah, exactly, because today is Monday, March 9, 2026. And depending on what kind of investments you track or even just, how closely you follow the broader healthcare industry.
Or just the news in general at this point.
Right. Today's a date that is likely going down in the history books. We're doing a deep dive into a really explosive new analysis report that just crossed our desks.
It's massive.
It is. It outlines a complete structural recalibration right at the intersection of Wall Street and Big Pharma.
It really is a watershed moment for the industry.
Yeah.
I mean, we are looking at a situation where the fundamental rules of how medicine reaches the public they're basically being rewritten in real time.
Exactly. So our mission for this deep dive is to figure out how a single headline, literally just a few sentences on a financial terminal, fundamentally transformed a company.
Overnight.
Right, overnight.
Yeah.
Taking them from a risky kind of gray market disruptor into a fully sanctioned big pharma powerhouse.
Yeah.
And the focus of this analysis report is very clear. It's titled, The Partnership That Changes Everything. HIMS and Novo Nordisk.
And, to fully appreciate this, we really need to look far beyond just the daily stock ticker.
Definitely.
Because this isn't just a story about a share price jumping. It is a massive paradigm shift in how blockbuster drugs, and specifically, we're talking about the most sought-after weight loss medications on the planet, how they will be distributed to everyday consumers. It changes the entire ecosystem of healthcare delivery.
Okay, let's unpack this, because the numbers we are looking at today are they're incredibly significant.
Mind-blowing, really.
Let's start with the market reaction. Shares of HIMS and Hers Health, ticker symbol HIMS, orchestrated a truly historic breakout. The stock surged over 40% in a single trading session.
Yeah, 40%.
We are talking about gapping up from a previous close of $15.74 and pushing straight past the $22 level.
And a 40% move in a company of this size is staggering on its own. But for you listening, the price action is really only half the story here.
What's the other half?
The volume. The analysis report highlights the underlying volume, which was over 174 million shares traded today.
Wow.
That is more than 500% of its normal average volume.
Which is just a massive amount of conviction from the market.
Right. And I want to clarify exactly what that means for you, because it's crucial. When you see volume at that level, it's not retail traders just, clicking buy on a brokerage app on their phones.
Right. It's not a meme stock rally.
Exactly. And it's not a simple technical short squeeze where people are just forced to cover bad bets. That kind of volume represents deep-pocketed institutional money. The market was frantically repricing the company's entire future.
Basically the sound of thousands of financial models being updated all at the exact same time.
Yes.
But to understand why the market reacted with such urgency, we really have to rewind. We have to look back to earlier in 2026 to explain the massive legal overhang that was just suffocating HIMS.
They were on a totally different trajectory just a few weeks ago.
A much more precarious one. They had recently launched a $49 compounded oral semaglutide pill.
Right. And for anyone who needs a quick refresher, semaglutide is the active ingredient in Ozempic and Wegovy.
The blockbuster drug.
Exactly. So HIMS was offering a compounded version of this for $49. But the mechanics of how they were legally allowed to do that is what put them on a collision course.
Precisely. And that requires us to just briefly understand the FDA shortage loophole.
Right.
Normally, you cannot just copy a patented drug. The entire pharmaceutical industry is built on very strict patent protection.
Of course.
But because Ozempic and Wegovy were on the FDA's official drug shortage list, meaning the manufacturer literally couldn't make enough of it to meet the massive public demand, regulatory rules temporarily allow compounding pharmacies to make what are essentially copies of the drug.
Oh, okay.
So HIMS capitalized on this specific temporary loophole.
They saw the massive consumer demand, they saw the official shortage, and they stepped right in to fill the gap.
They did.
But that strategy has a massive built-in expiration date, doesn't it? It absolutely does. The very second those drugs come off the official shortage list, that entire revenue stream becomes illegal overnight.
Ooh.
You have to shut down production immediately. That was the ticking time bomb underlying their entire weight loss strategy. They were building a highly lucrative revenue stream, but they were doing it on borrowed time.
And obviously, you don't just severely undercut the biggest pharmaceutical companies in the world without a reaction.
No, you don't.
The backlash was severe. Novo Nordisk, the titan behind Ozempic, filed a massive patent infringement lawsuit against HIMS.
Which is terrifying for a smaller company.
And if that wasn't enough, the FDA started signaling it was going to severely restrict the compounding of GLP-1 medications across the board anyway.
It was a perfectly coordinated squeeze. HIMS was basically at war with federal regulators on one side and the world's most powerful drug makers on the other.
Very bad place to be.
The worst. Because Novo Nordisk doesn't just sue you. They have infinite resources to tie up disruptors in court for years. Decades even.
Yeah.
And institutional investors fled because they simply couldn't model that kind of legal risk. They hated the uncertainty.
So the fallout was brutal. As a result of all that pressure, the stock just cratered, dropping over 50% from its 52-week highs.
It looked like the classic Silicon Valley story. A disruptor flying too close to the sun and getting entirely burned by the harsh realities of healthcare regulation.
Which is exactly what makes today's news feel like whiplash.
Total whiplash.
Because the analysis report details a stunning reversal, a blockbuster ceasefire. HIMS and HERS officially announced a strategic partnership with Novo Nordisk.
Yeah.
And I have to say, you rarely see a company the size of Novo Nordisk just drop a patent lawsuit against a pesky disruptor. Usually, they litigate them into oblivion just to set an example for the next guy.
Right. What's fascinating here is the sheer speed of this pivot. They went from bitter enemies trading legal blows in the courtroom to absolute allies in distribution.
In the blink of an eye.
The specific terms of this deal, which are sourced directly from the analysis report, served as a masterclass in corporate negotiation. Let's break down the trades they made.
Let's do it.
First, HIMS agreed to immediately stop advertising their unapproved compounded GLP-1 offerings.
Okay, making peace.
Second, they committed to systematically transitioning their existing patients over to FDA-approved branded medications.
So they're moving them off the gray market stuff.
Yeah.
And what does HIMS get in return for giving up their golden goose?
The ultimate prize. In exchange, Novo Nordisk is entirely dismissing its lawsuit against HIMS without prejudice.
The legal cloud is just gone.
Vaporized. But it actually gets better for HIMS. Because of this deal, they now have a brand new, fully sanctioned pipeline.
Right.
Later this month, HIMS will officially distribute actual Ozempic and Wegovy, both the pills and the injections, directly through its telehealth platform.
That is just incredible. They aren't just stepping away from the compounded drugs. They have secured the direct distribution rights for the genuine, branded, most in-demand medications on the planet. They traded a highly contested, legally precarious product for the absolute gold standard of obesity treatment.
And that completely rewrites the entire investment thesis for the company.
Yeah.
Think about the death of the bear case against HIMS here.
Right, because the main argument from short sellers, the people actively betting against the company's survival, was that HIMS was essentially a house of cards.
A legal house of cards.
Yeah, they argued the whole business was built on this shaky shortage loophole, and the moment Big Pharma or the FDA cracked down, the whole thing would just collapse into dust.
And with this partnership, that legal overhang, that entire bear case, is officially completely dead.
Gone.
If we connect this to the bigger picture, the death of the bear case is really just the first domino to fall.
That's the bigger takeaway.
Big Pharma validation. Novo Nordisk dropping the lawsuit proves something highly revealing about the modern healthcare landscape. They didn't just back down out of the goodness of their hearts.
Right, these are aggressive corporations.
Exactly. They looked at the internal numbers and realized they actually need HIMS and HERS. They need that massive, highly sticky consumer base to move their products efficiently.
Think about the traditional way we get these medications. You take half a day off work, you sit in a waiting room reading a magazine from 3 years ago, you talk to a doctor for maybe 5 minutes, and then you go wait in another line at the local pharmacy.
It's a terrible user experience.
It really is.
Yeah.
And HIMS realized that for lifestyle medications, people just want the Amazon Prime experience. Click, consult, deliver.
Seamless.
Novo Nordisk, a company that has been around for over a century, looked at this digital health platform and realized they couldn't beat that level of logistical convenience. They had to partner with it.
Which means HIMS is officially validated. They aren't just some fringe startup anymore. They are a legitimate institutional distribution channel for Big Pharma.
Yeah.
And let's look at the customer retention angle, which is a stroke of absolute genius by HIMS management. Think about the massive influx of weight loss subscribers HIMS gained when they offered that $49 pill.
Right, they acquired a huge user base through that aggressive pricing.
So they essentially used the compounded drug as a loss leader, or at least a really cheap customer acquisition tool, to get millions of people onto their platform.
Brilliant.
And now, instead of losing all those customers due to legal injunctions, HIMS gets to keep them. They simply shift those patients over to the safer, FDA-approved branded drugs.
And according to the analysis report, they are reportedly keeping the out-of-pocket costs highly competitive for those users.
Right. It is a seamless transition for the consumer, but an incredible upgrade in revenue quality for the company.
Here's where it gets really interesting, because when a structural shift like this happens, Wall Street completely scrambles.
Oh, it's a frenzy.
You have major analyst firms practically tripping over themselves to upgrade the stock and adjust their financial models to account for this new reality.
They have to.
The analysis report notes that Citi immediately upgraded the stock to a $24 price target, specifically citing this massive de-risking event.
Right.
And Needham went even further. They floated price targets all the way up to $30.
The de-risking of the company just cannot be overstated here. When you remove an existential threat like a federal patent lawsuit from a global giant, the valuation multiple naturally has to expand.
Okay, I have to play devil's advocate for a second here.
Please do.
When a stock jumps 40% in a single morning, human nature tells us it has to be overbought. It's due for a correction. What is the actual financial justification that this isn't just a hype bubble? Are they actually generating the cash to back up a $22 share price?
It's the exact right question to ask, but according to the financial synthesis in the analysis report, it isn't a bubble. They provide a very sobering valuation reality check.
Okay.
Even after a 40% face-melting rally today, trading at around $22 a share, the stock still isn't historically expensive.
Really?
No, it boasts a forward price-to-earnings ratio of under 20x based on 2026 consensus estimates.
Let's break that down for the listener. What does a sub-20x forward PE actually mean in the context of this specific market?
To put that ratio in perspective for you, even after the stock price skyrocketed today, you are still basically paying less than $20 for every $1 of profit the company is projected to make next year.
Got it.
For a tech-forward growth company that just secured a big pharma pipeline, Wall Street usually demands a much, much steeper premium than that.
Right.
With management forecasting $2.7 to $2.9 billion in revenue this year alone, for a highly profitable company with that kind of top-line revenue, completely shielded by a partnership with Novo Nordisk, a multiple of under 20 times forward earnings is arguably still a huge bargain.
So the 40% jump was just the stock violently catching up to its new legally secure reality.
Exactly. Tech companies growing this fast often trade at 30, 40, or even 50 times their forward earnings.
So the financials actually support the hype. That is incredibly rare.
Very rare.
Now, to really understand how significant this all is, we have to look at the competitive landscape. It's interesting because the analysis report refers to some of these legacy telehealth competitors as dinosaurs.
Dinosaurs, yes.
And it notes that HIMS is actively building a graveyard for them. I remember when companies like Teladoc were the absolute darlings of the pandemic era.
The contrast drawn in the report is incredibly stark. They focus specifically on Teladoc as the prime example of this divergence in the sector.
Teladoc was the pioneer.
They were. During the lockdowns, their adoption rate was unprecedented because people had no other choice. But right now, they are functionally stagnating. They are experiencing almost negligible growth.
It seems like their entire model relies on selling bulk subscriptions to employers.
Right.
Does HIMS bypassing the employer and going straight to our credit cards really give them that much of an edge? Or is Teladoc just failing to innovate?
It's fundamentally a difference in business models. Teladoc operates primarily as a B2B enterprise, business to business.
Okay.
They sell their services to large employers and massive health insurance plans. It's often bundled as just another HR perk.
Like vision or dental?
Exactly. But in a post-pandemic world where people have eagerly returned to in-person doctor visits, Teladoc is really struggling to find its post-pandemic identity.
Yeah, makes sense.
Their total addressable market, or TAM, is artificially capped by the corporations they can actually sign contracts with. And frankly, a B2B model severely limits your ability to market lifestyle weight loss drugs directly to consumers.
Because you have to go through the gatekeeper of the employer's health plan.
Yes.
And HIMS is playing a completely different game entirely. They don't care about your employer's HR department.
Not at all.
The analysis report calls HIMS a direct-to-consumer, or D2C, juggernaut. They are actively expanding their total addressable market because they go straight to you, the individual patient.
Exactly. HIMS and HERS has successfully accomplished something that is exceptionally difficult in the medical field.
What's that?
They successfully merged lifestyle branding, making healthcare feel accessible, modern, and even stylish with incredibly serious, highly regulated healthcare logistics.
Think about the branding difference. Teladoc feels like a virtual waiting room for when you have a sinus infection.
Right.
HIMS and HERS feels like a modern lifestyle brand that just happens to prescribe clinical-grade medicine.
A virtual waiting room versus a consumer lifestyle pipeline, that perfectly encapsulates the divide. Teladoc provides a utility, HIMS provides an experience.
And now they have the ultimate stamp of approval, big pharma backing.
Yep.
They've essentially proven that the direct-to-consumer model isn't just some gimmick for selling hair loss serum online. It's a highly viable pipeline for the most important drugs of the decade.
Which is exactly why the dinosaur label applies so well. If you are a legacy telehealth company relying on B2B contracts right now, you are watching a competitor build a direct daily relationship with the end user.
HIMS owns the customer data, they own the branding, and they own the distribution.
And Teladoc only owns the software interface between a doctor and an employee.
So what does this all mean? If we step back and look at everything detailed in this analysis report, what is the ultimate takeaway for today, March 9, 2026?
The bottom line is that HIMS just had its grow-up moment.
Yeah.
They traded the high-margin but incredibly high-risk world of mass compounding for the sustainable, massive volume, lower-risk world of branded pharma distribution.
It's a true maturation process for the company. They proved to the world they can navigate the most complex regulatory environments that exist.
They really did.
They sailed their ship straight into a Category 5 regulatory storm, fought a bitter battle with the FDA over compounding loopholes, went toe-to-toe with Novo Nordisk in federal patent court.
And survived.
And ended up coming out the other side, literally holding hands with the biggest player in global obesity drugs. It's a corporate maneuver that will likely be studied in business schools for years.
Absolutely. And here's why you, the listener, should care deeply about this shift, even if you don't own a single share of the stock or take any of these medications yourself.
Why does it matter to them?
Because this partnership proves definitively that direct consumer health platforms aren't just a lingering pandemic fad. They are the new permanent distribution arm for the biggest medical advancements in the world.
The traditional model of making a doctor's appointment, driving to a clinic, getting a paper prescription, and waiting at a local pharmacy.
It's being actively disrupted by a seamless, digital-first experience. And Big Pharma is fully embracing it because they recognize that the logistics matter just as much as the medicine itself.
They have to embrace it because at the end of the day, that Amazon Prime-style convenience is exactly what the modern consumer demands, even for their healthcare.
Exactly. Which brings us to a much broader implication.
Oh.
This raises an important question, something for you to really mull over after we wrap up today.
Let's hear it.
If a century-old pharmaceutical giant like Novo Nordisk just publicly admitted that they actually need a digital lifestyle consumer brand to effectively distribute their most prized, highly regulated weight loss drugs, what else is coming? What other highly regulated, complex medical treatments are about to entirely bypass the traditional doctor's office and go straight to our phones next?
A fascinating thought to leave on.
Yeah.
The infrastructure is there, the validation is there, and now the precedent is officially set. It really makes you wonder what our healthcare system is going to look like just 5 years from now.
It's going to be unrecognizable.
Well, that wraps up today's deep dive. We hope this helped clear the noise and gave you a front row seat to the partnership that changes everything. Thanks for joining us, and we'll catch you on the next deep dive.
Don't forget to like, share, and subscribe for more.